In 2000, Enron was hailed as America's most innovative company for the sixth year running, valued at nearly $70 billion. Its executives were business celebrities, trusted by investors, employees, and politicians alike. Enron seemed like the ultimate success story until it all unraveled. Beneath the surface, Enron's real innovation was creative accounting, turning financial fiction into apparent fact. The company's profits, stock price, and reputation were built on a foundation of lies. Enron reported impressive earnings quarter after quarter, fooling Wall Street and the media. But behind closed doors, the company was hiding billions in debt. The operation was a masterclass in deception, designed to inflate Enron's value at any cost. The corporate culture encouraged pushing legal and ethical boundaries, all to keep the stock price soaring. Investors, employees, and the public were sold a fantasy. The truth? Enron was a house of cards, and the collapse would be spectacular. The company's leaders, Ken Lay and Jeffrey Skilling, orchestrated the illusion with precision. But no amount of polish could hide the rot forever. The stage was set for one of the biggest corporate scandals in history. How did Enron pull off such a massive deception? It started with mark-to-market accounting. Instead of recording profits when money was actually received, Enron booked estimated future profits the moment a deal was signed. This let them count imaginary money as real revenue, creating the illusion of endless growth. But those profits were just guesses, often wildly optimistic ones. To hide losses, Enron created a web of special-purpose entities, or SPEs, with names like Raptor and Jedi. These shell companies took on Enron's bad debts, making the company look healthier than it was. On paper, the debt vanished. In reality, it was just hidden from view. The result? Enron appeared to be a lean, profitable powerhouse, while toxic assets pile up out of sight. This accounting magic trick kept the stock price climbing and investors happy. The entire scheme depended on no one looking too closely. The illusion was so convincing that even seasoned analysts and regulators were fooled. But the bigger the lie, the harder it is to maintain. Enron's financial statements became a maze of confusion designed to obscure the truth. The company's real business was no longer energy, it was deception. And the cracks were starting to show. One lie led to another, and soon Enron was trapped in a cycle of deception. The pressure to meet Wall Street's expectations forced executives to double down on risky accounting. Bonuses were tied to closing deals, not actual profits, fueling reckless behavior. CEO Jeffrey Skilling's rank-and-yank culture silenced dissent and punished whistleblowers. Employees who questioned the numbers were quickly shown the door. The company's financial reports became impenetrable, hiding the truth in jargon and complexity. As the lies grew, so did the risk, until it was too big to hide. In August 2001, Skilling abruptly resigned, raising suspicions. Whistleblower Sharon Watkins warned that Enron could implode in scandal. Soon after, Enron announced massive losses and revealed hidden debts. The market panicked, the illusion shattered. The company's magic trick was over, and the truth was impossible to ignore. Investors and employees realized the empire was built on sand. The collapse was swift and total. Enron's downfall became a symbol of unchecked corporate greed. When Enron declared bankruptcy in December 2001, the fallout was devastating. Over 20,000 employees lost their jobs and, for many, their life savings. Retirement accounts invested in Enron stock were wiped out, leaving families with nothing. Executives had cashed out millions while locking employees' accounts as the stock crashed. The pain spread beyond Enron. Individual investors and pension funds lost billions. The scandal shattered trust in corporate America and sent shockwaves through the market. Top executives, including Skilling and Lay, were convicted of fraud. Arthur Andersen, Enron's accounting firm, collapsed, costing 85,000 jobs worldwide. Justice was served, but the damage was irreversible for thousands of ordinary people. The numbers on Enron's balance sheet represented real lives and futures destroyed. The collapse was a brutal lesson in the cost of corporate dishonesty. The scars would last for years. What did we learn from Enron's collapse? The scandal led to the Sarbanes-Oxley Act, forcing greater corporate accountability and transparency. Executives are now personally responsible for their company's financial statements. The disaster also taught the importance of diversification. Never bet everything on one company. Skepticism is crucial. Don't trust hype or glossy reports without asking tough questions. Yet the pressures that fueled Enron's downfall, greed, short-term thinking, and fear of bad news still exist. The story is a cautionary tale about ethics, hubris, and the consequences of lies. We need vigilant watchdogs and an informed public to hold power accountable. The temptations of greed are timeless, and the lessons of Enron remain relevant. Stay alert, stay skeptical, and demand the truth. For more stories like this, follow our channel for future deep dives.